Most investors spend their days reacting to the headlines. They chase the latest earnings beats, political sound bites, and central bank rumors. But reacting to yesterday's news puts you constantly a step behind. Price movements are driven by the shifting tectonic plates of the macro cycle, deep structural changes that occur long before a headline hits the wire. To see those shifts before they happen, we need a forward-looking roadmap. That is exactly what the Logic Macro Regime Framework is designed to do: identify where we are today, where we are heading over the next 6 months, and how to position portfolios with high conviction. The framework evaluates the 5 foundational pillars of the economy: L for the liquidity cycle, O for other financial conditions, G for the growth cycle, I for the inflation cycle, and C for capital positioning. By tracking these specific pillars, we capture the major forces driving asset prices and translate them into a single, systematic framework that replaces guesswork with measurable structure. The first step is answering a critical question: what environment are we actually in? This matrix maps out our primary macro coordinates. We plot economic growth on the vertical axis and inflation on the horizontal axis. When growth accelerates while inflation remains contained, we enter an early cycle expansion known as Goldilocks. Historically, this provides strong support for equities, particularly large-cap growth, technology, and high-beta stocks. As the cycle matures into mid to late expansion, demand strengthens, capacity tightens, and inflation builds. We call this reflation, a phase where market leadership typically rotates towards small caps, cyclicals, and commodities. In a late cycle environment, rising costs start to pressure profit margins. Growth slows down while inflation stays stubbornly high. In this inflation regime, defensive assets like gold, treasury inflation-protected securities, and dividend-paying stocks tend to perform best. Finally, a cold economy brings weak demand and falling prices. During a deflation regime, investors historically seek shelter, and defensive positions like cash and high-quality bonds typically outperform. This sequence follows the natural rhythm of a business cycle. Early expansion eventually fuels overheating demand, which leads to slowing growth as costs rise, and finally a cooling period before the process restarts. This creates a recognizable, clockwise progression through the matrix. Knowing the regime tells us what type of environment we are in. But the next layer of our diagnostic framework answers a different question: exactly how much risk should investors be taking right now? As you can see, this new tool sits directly on top of the macro matrix. We call it the risk bias score. It operates on a scale from 0 to 7. Scores between 0 and 3 signal a defensive risk-off posture, while scores between 4 and 7 flash a green light for risk-on. This score is calculated using real-time financial conditions. We take the liquidity cycle, other financial conditions, and capital positioning, the L, O, and C from our LOGIC acronym, as the foundation. Then we layer in 5 key global leading indicators: the US dollar index, China's credit impulse, the OECD CLI diffusion index, the percentage of central banks cutting interest rates, and also the lagged effect of US federal government interest payments. Because this score measures the financial system's actual capacity to support risk assets, it operates independently of the economic cycle. A risk-on or risk-off environment can be triggered inside any of the 4 macro regimes. When we combine the current macro regime with the precise risk bias score, the framework produces our ultimate forward-looking output, the monthly macro map. This unified dashboard shows exactly where the economy stands today, the current level of risk tolerance in the financial system, and the projected trajectory for the next 6 months. The math behind this map has been systematically backtested against market data going all the way back to September 2011. We evaluate how different assets, sectors, and investment styles, spanning stocks, bonds, commodities, and currencies, have historically performed across every single macro regime. The research prioritizes risk-adjusted performance, identifying asset combinations that maximize long-term compounding by strictly controlling downside volatility. When you replace reactionary guesswork with a quantitative roadmap, you trade anxiety for discipline. You gain a clearer understanding of risk and the ability to position capital with confidence. Markets will always change, but macro cycles follow recognizable, measurable patterns. Learn to navigate the cycle, and you can map out exactly what comes next.